Joining us now, Lindsey Piegza, chief economist at Stifel, and Michael Gapen, head of U.S. economic research at Barclays. We've been talking about the phantom recession. Was it a phantom recession, or did the Fed step in and save us? Was it ever real, Michael?
It was getting real. I think by that, the manufacturing sector was clearly in recession.
Globally, almost, yeah.
Globally, yes. The question was, would it spill over into services? There was some initial worry about that in the August and September employment reports because services employment was slowing. The October data takes that away. So it looks like we're set. I think the base case is activity in the U.S. and globally should probably bottom out in Q4, and we're set for a little bit of a rebound.
Who saved us, Lindsey, the consumer or Jay Powell?
I don't know if you can say that we're saved.
We're not saved yet?
I think there's still a risk that we continue to
Someday.
see downward momentum. I think manufacturing is still in trouble. We see business investment still in net negative territory. And this morning's consumer numbers, while they were an improvement from last month, certainly don't set the table for we're out of the woods yet. The consumer still is on very moderate footing. And remember, the consumer is the sole support to the economy right now. So we really needed to see more robust numbers on the spending side to suggest that we are going to see a more favorable activity level overall when we talk about GDP for Q4.
Both bond market and the stock market seem to decide, or it seemed to have settled on the notion that the slowdown has been averted. Would you disagree?
Well, I think the market is buying into the notion.
Which market?
That, well, both. We're seeing the equities and the fixed income market buy into the more positive rhetoric that we've seen from the Fed, that they've done enough to stabilize the economy in the near term. But I don't think the market is yet sending the signal that the longer-term outlook is favorable. If we did, I think we would have seen a stronger
then the stock market's
backup.
way ahead of itself then.
Well, the stock market's always ahead of itself.
Well, is it ahead of itself
incorrectly?
Is it ahead of itself incorrectly?
Well, the stock market is also pricing in not only a phase one deal, but a longer-term, lasting, meaningful trade deal, providing a rebound not just to domestic growth, but to global growth as well.
You don't think this is just a pause, or that the stock market's happy to just have like a détente at this point?
Well, it could be. I mean, it seems like the stock market is looking for any signs, any green shoots to trade up on. But I don't know if this changes the picture of the fundamentals, which in my opinion still remains very tepid.
You don't necessarily feel quite as strongly about that, do you, Michael?
Not quite as strongly. I think to Lindsey's point, 0.3 month-on-month for core retail sales is, I think, what we averaged in Q3. But the July data was the strong number, right? So I think if you keep getting 0.3s, we'll actually decelerate into Q4. But I think I agree with what Becky's saying, is I do believe that equity markets are responding mainly to phase one. I don't really see a phase two in the cards, so I would agree with a little longer term view that Lindsey has there. But I think markets want to know, did we reach peak tariffs? And are we backing off from that? And if we have, then I think market pricing is reflecting that.
So we're spending a lot of money as a federal government. We had Paul Tudor Jones on everybody, but we had him, Paul Tudor Jones, on the other day saying that's the bubble. That's the big. The next problem we have is going to be that rates ever go up, we're not going to be able to cover the debt service, and there's absolutely no one even talking about it anymore.
Well, that's not true. Chairman Powell actually talked about it yesterday and Wednesday, talking about the fact that federal debt...
He doesn't control any of the fiscal...
He doesn't control it, but he did point out that if the economy does take a turn for the worse, there will be no fiscal support. There's just no money. There's no additional appetite, if you will, in Washington to provide stimulus. So the onus will fall on the Fed. But because rates are already starting from such an extremely low level, there's very little ammunition that the Fed has to prop up a faltering economy at this point, at least in terms of traditional rate cuts. Right. They'd have to go to non-traditional metrics, such as growing the balance sheet.
Are we in a permanently lower yield environment, Michael?
For the foreseeable future?
Well, how long is that?
5 to 10 years? Yeah, I think so. I mean, 180 on the 10-year is high for G10.
What do pension plans, seniors, retirees, what are they supposed to do?
It's a different return environment.
Tighten the belt?
And over time, yes, because what'll be thrown off from asset portfolios will be lower.
What about retirement plan? What about insurance companies? What about everyone that's dependent on saving?
Well, the return bogeys have to come down. But that's nobody's fault. It's a reflection of the world the way it is.
And does the advantage of debt service not going up for all the borrowers, is that offset that savers can't make any money? I mean, is it a net positive? We keep talking about net positive. Nothing's totally.
I would say it depends the answer to that it depends on what you do with what you borrow. Certainly, if we do have another downturn, my argument would be just go ahead and use your fiscal resources. Lower interest rates give you more space, and then it would depend on what you want to do with that. So I do think that there's a countercyclical role that fiscal can play in the next downturn. I wouldn't let the size of the current deficit, which is very large by historical standards, dissuade you from doing that, because I think the outcomes of not doing that would be worse.
All right. Well, I'm not inviting you guys in here on a Friday again.
Mondays are okay?
Mondays, yeah. You match our mood exactly. Anything positive going to happen down the road?
Well, I don't think that we need to be depressed leaving this conversation.
Well, because it's Friday, I'm not going to. I mean, there's nothing you can say.
It's still in positive territory,
Yeah.
but we have to recognize that it's very moderate growth. And the downside risks, again, as the chairman pointed out Wednesday and Thursday, they are growing from trade, from slower growth, from rising debt levels, both at the corporate level and the federal level. So there are a lot of barriers that we have to overcome, but we're still in positive territory, at least for the near term.
Okay. All right, Lindsey, thanks.
Thank you.
Thanks.